Whenever I talk about investing in stocks, I usually suggest you can earn a 7% annual average rate of return. And this percentage is based off a few assumptions. Firstly is I'm assuming you're investing for the long term, over 10 years. Given that the stock market is extremely volatile, some years you might expect massive gains, and some years you might get a massive dip. However, in the long term, you will average out to about 7%. Secondly, I'm assuming you're investing in something that's very broad-based, such as a total market index fund. The 7% return doesn't really apply if you're only investing in one or two individual stocks, because as we know, individual stocks are very volatile. Hi, Vincent Chan here, and in today's video, we're talking about where the 7% average annual rate of return comes from. And if that sounds good, make sure you smash the subscribe button and ring the notification bell to always get the latest and greatest from the Simple Dollar. And remember, you can find this content and loads more by visiting thesimpledollar.com. My primary source for the 7% number comes from Warren Buffett himself, where he stated point blank that you can average out and expect a 6 to 7% annual rate of return when you're investing long term. More specifically, he stated that the economy as measured by GDP can be expected to grow at an annual rate of about 3% over the long term. And an inflation of 2% would push the nominal GDP growth to 5%. Stocks will probably rise along that rate, and with dividend payouts, it'll boost the total return to 6 or 7%. But you might be asking yourself, didn't the stock market do much better in the past? The S&P 500 index, which is a benchmark for the US stock market, actually surged 18% on average every year from the year 1982 to 1999. This bull market tainted investors' expectations. In fact, a poll done in the 1990s, investors expected the stock market to increase 14 to 15% on average every year. Beyond that, the long-term data with stock market performance also shows an average return of 7% every year. For example, from the period of 1950 to 2009, if you take a look at the S&P 500 index and you account for inflation and dividends, then the average total return is around 7%. Based on these two things, one, Warren Buffett's analysis, and number two, historic market performance, then we can safely assume an average annual rate of 7% per year in the long term. However, we must understand and realize the simple statement that is true for pretty much everything, and that is past performance is not indicative of future return. Still, if you're looking into the future and for retirement, then investing in the stock market is still very worthwhile. As always, thank you so much for watching. If you have any questions about the 7% annual rate of return, feel free to leave a comment down below and we'll get back to you as quickly as possible. And remember, if you enjoyed this video, make sure to smash that like button and smash the subscribe button to always get the latest and greatest from the Simple Dollar. And remember, you can find more content like this by visiting thesimpledollar.com.